Hello and welcome to this episode of Money View from the Top. Joining me today is an industry veteran, Anthony Heredia, who is currently the Managing Director and the CEO at Mahindra Manulife Mutual Fund. Anthony has had many stints over the last 2 decades, and he understands the mutual fund industry better than anyone. Thank you very much, Anthony, for talking to the viewers of Daily Hunt. As you are aware, the viewers of Daily Hunt reside across the country, and therefore, as you have seen, a greater interest coming from the small towns and cities, and they're looking forward to getting your views on what they should be doing. So thank you very much for joining us here in this interview. My first question, Anthony, we live in very volatile times. If we were speaking even 3 days ago, we would have been talking. The first question would have been, oh, we are in a rally. And suddenly things change in the last 2 days, and I'm sure things will change again in the next few days. So we live in volatile times. What would be your advice to a retail investor in this kind of a situation where there's such wild swings?
Sure. Vivek, firstly, thank you for the opportunity. It's always great to have a conversation with you. And you've been very kind to say that I know the ins and outs of mutual funds. I think if there's someone who does know the ins and outs of mutual funds, it's you, but we'll leave it at that. So I would say that the answer I would give today is actually similar to 3 days ago. And that would firstly be to stay the course. Because this volatility that we've seen over the last, I would say, 6 to 9 months is something that I would say, for lack of a better word, intellectually, many have predicted for perhaps the last 15 to 18 months, right? We have had a situation where liquidity that most central banks have given all major economies for almost now a decade, because if you actually go back to the 2008 financial crisis, I mean, liquidity has been seen as the super medicine to solve all ills. And for the first time in over a decade, we are now starting to see what happens when that liquidity is no longer possible to be taken for granted. Having said that, when you buy equities, I think it is really about buying companies. You're buying their future earnings, and you're buying the market's perception of those future earnings. And as long as that continues to be broadly on track, eventually the results in terms of your portfolio returns will come. I think it's only a matter of sometimes timeframes being redefined. And so I would say that these are actually times when I think back to my 25 years in the market. These are times which actually help you make money, because there is lots of noise. There will be lots of reasons not to invest. But at the same time, if you think about it from I would say 3 to 5 year time frame, and also in the context that, I'm just caveating it, we're referring to India and the opportunity. There is enough evidence to show that we're in for a reasonably positive ride over the next 3 to 5 years, and eventually markets will recognize that. Having said that, I would also caveat that besides the liquidity, historically, Indian markets in the short term have never done well because company earnings have not done well at times when oil has been over $100. And so we must be mindful of that. We can't pretend that we've evolved so much that perhaps we will not have a CAD issue this time around, but to expect that, margins will not be under pressure, demand will eventually not falter because in order to fight inflation, central banks raise rates, liquidity starts dropping, that has to have an impact. But the point I'm making in terms of staying the course is that these are things that eventually solve themselves. And it is normally the rational, patient investor who's investing for the right time frame, that eventually makes money. And I would say whether it is 3 days ago when there was a little more exuberance to perhaps today where everybody is watching with bated breath what happens on the weekend, for the retail investor, I think the answer remains the same. Don't over-intellectualize the situation. Stay the course, figure out what your goals are, and make sure you're invested in the right funds.
So, Anthony, when a person is, bombarded with so much of information, especially a lot happening globally. You talked about the last 9 months. We've seen a war going on in one part of the world, which doesn't seem to end. We've seen very high inflation rates in some of the developed countries. Oil, you already talked about. Liquidity, the monetary policy, the tightening. How should an investor read all this? I mean, it's almost impossible for a layperson to comprehend any of this. And you made the point that stay invested. So my question is, if I'm someone who's convinced that, yes, I need to invest in equities, at least some part of my portfolio, and we'll talk about the importance of asset allocation in just a bit. What's a good starting point, according to you, Anthony? I know we can't talk about schemes here, but from a category point of view, what's a good starting place for a retail investor who wants to take some kind of an exposure to equity?
So I would say, to my mind, one category that makes a lot of sense, and it's not in today's times. I think it's the first fund category that every investor should pick up, is the Flexi-cap fund that any fund house runs, because the fund manager having the opportunity to buy the right companies without the constraints of market caps, sectors, etc., effectively means that he has the freest hand possible to add value to the portfolio. And at the same time, because classically, large caps do create, have such a large part of the index, in a sense, it's probably the best way to start. Conventionally, it's always been that start with a large cap fund, but I would say that over the last 3 or 5 years, I am increasingly convinced that the Flexi Cap fund is a great starting point. Having said that, there's another category that is evolved in the last 3-5 years, which I think is brilliant for especially first-time or relatively new investors. And that's a category called the balanced advantage. Because all it does is effectively take the Flexi Cap fund and add some sense of a discipline to valuation to that fund. And so effectively, the fund will be invested more in equity if it believes valuations are in favor. And conversely, if it thinks markets are overexcited, it will take some money off the table. And over time, I would say that that's a great risk-adjusted return that the investor gets. So I would say these are the two fund categories that an investor should have. The third, I would say, is a category that I'm frankly disappointed hasn't got the airtime it should have. And I'm saying this because you have two classic sets of people who would look at a mutual fund for the first time, or not just for the first time, but in general, right? I mean, you have people who are understanding of the power of equities. They have perhaps direct equity investors, and over time they understand that there's only so much you can do yourself. You kind of get the same results, if not better, buying a mutual fund. But the larger pool out there is the classical Indian fixed deposit investor. And sometimes I do believe that our industry's urge to move that investor directly into straight equity may be a journey too far. And there is a category called equity savings, which is another version of balanced advantage, albeit conservative, that tries to keep a 20-30% equity allocation, is sensitive to valuation, that I think becomes the ideal starting point for a conservative investor. So if I was to summarize, I think If you're an investor who's getting used to mutual funds and you're conservative, historically fixed deposits have driven your asset allocation, start with equity savings and a bit of flexi-cap. If you're an investor who's relatively younger, therefore perhaps not so much fixed deposits, and you have clearly wealth creation goals, then a combination of flexi-cap and balanced advantage is good to go. I'll just make one last comment. Frankly, this is all you need. It's not even about the first time investor. I would say that for the absolutely savvy, time tested investor like you and me, Vivek, I think these two products effectively give us 90% of what we need to achieve. The 10% that we do by buying, X fund, Y fund, Z fund is probably more for enjoyment than actual return, incremental.
Anthony, there's been a lot of debate around passive versus active, and again, there are some fund houses who have decided to say that we'll only do passive funds. And just to explain this to our viewers, these are basically index related funds, passive funds, and active funds are those where the mutual fund managers actually take calls. Do you believe that, while globally, and you've had, a fair amount of global exposure in your career, do you believe that while globally index funds have taken off in a very big way because they're low cost, for the Indian market, and again, as a fund house, as I understand, your focus is to try and go into more the smaller towns and cities. How do you see the passive versus active balance emerging as we go along?
So I think it is eventually going to be a reflection of how many fund managers are going to be able to successfully outperform the index consistently over long periods of time. Is it worth sticking to only active, or should passive play a role? Globally, we also have a situation where markets are a lot more mature. And so to that extent, information is freely available. Price discovery, therefore, becomes a lot more institutionalized. And the ability for a human mind to then extract value becomes that much more challenging. I think in the Indian context, we have easily over a decade to reach that point. I think one of the beauties of the Indian market is the sheer diversity of companies that one can buy. It's not just in terms of capitalizations, it's just purely in terms of sectoral diversity, etc. So in that context, as a fund house, speaking for ourselves that are very clear that we will predominantly remain active, do we feel confident that we can add value consistently over the long term sitting right now? The answer is 100% yes. Do we feel confident that every one of us in the industry will be able to do so? I am not so sure. And I think the extent to which, as an industry, we're able to produce our performance for the extra fees or TERs that we're charging, it will determine the extent to which people migrate to passive. The other thing that I expect to happen is actually, rather than getting into this debate about passive versus active, is probably around looking at moving from product to solution. And then sometimes what may happen is that, and then this is true in our context as well, you may choose to produce value because you focus on doing a few things well, right? The moment you try to do everything, that's when you start seeing things fraying at the edges. So maybe using index because it makes sense in creating a solution. So to give you an example, if we wanted to create some kind of a commodity tilt, do we actually add resources in building an active commodities fund management capability, or just do we buy a set of commodity indices and create a solution which is multi-asset for an investor for whom that makes sense? I think that's a path also that will emerge. So the debate, to my mind, will move from active to passive to, if an investor has a goal, what is the solution that I create that best meets that goal? And if there are index funds that provide a solution along active, then we should be open to it. Eventually, what should matter is what is right for the customer, right? Not what is right for us. All I'm saying, however, is as a fund house, we know that our DNA is active. And I think somewhere it's important to define that DNA because it puts added pressure. The moment I start saying that I will want to do active, I will want to do passive, I will want to do X and Y, I'm basically hedging my bets, right? The pressure on performance kind of comes off in a way. The fact that we've chosen to be active in some sense means that the investor's interest in eventually our performance and our business interest is completely aligned. Because I know that if I don't outperform over time, then investors that come to my active funds eventually are going to go to somebody else or they're going to go to passive. I'm not sure whether that's the complete answer to your question, but I
Absolutely.
would say that there's a role for both. How it will play out, only time will tell.
Sure. Anthony, we've been seeing a lot of NFOs coming out from a lot of mutual fund houses, and I think it's important to get your thoughts on under what circumstances should an investor consider an NFO. Planners over the years, of course, one is that we are seeing new players coming into the market, which is good news. So obviously they need to, get their first few funds in place. So there are NFOs, but even established mutual fund houses, are coming out with different kinds of NFOs. Again, not specific to you, this question, but this is more an industry interview. From an investor's point of view, under what circumstances should I invest in an NFO?
So, Vivek, like you rightly said, let me just first take one part of this out of the window, in the sense that there are a lot of credible new players coming to market. So obviously their first set of NFOs are going to be fairly rudimentary basic funds like Flexi-cap, large cap, etc., etc. And as long as you're convinced about the credentials of that fund house and what they represent over time, I think it is worth a consideration for sure. It sometimes the argument is, what's the point? It is the 41st Flexi-cap fund, but sometimes a fresh perspective backed by very credible set of people with great experience can add as much, if not more value than a time-tested strategy in the same space. The second category that I talk about, which I would endorse for sure, is when there is a product being offered which genuinely provides diversification. And squarely in that bucket, although we do have some limit issues now, I would say international funds clearly play that role. I think if you look at all global markets and successful investors there, diversifying beyond your country into other markets that also add value and offer value is a great thing to do. So I think over time, when there are NFOs that genuinely, without, if in 30 seconds you can answer that this is something I don't have in my portfolio of funds, and it clearly makes sense, then that NFO also makes a lot of consideration value. What I wouldn't endorse is if there are funds which are quite obviously too narrow in their focus, perhaps thinking about being very thematic because it's the flavor of the day. I'm not sure how much value they would add over time, because honestly, and I know we will get that in the conversation later on in terms of view on sectors and themes that will play out. I think the magic of the Indian market, and also the tough part for us managers, is in a dynamic world, it's impossible to kind of put your hand on your heart and say that I am absolutely convinced this sector or this theme will be the superstar for the next 5 years. I think it's a strategy fraught with risk. And sometimes in order to try to get that extra 1 or 2 or 3%, you end up chancing, I would say, a significant underperformance. And I would say those kind of NFOs, I would, unless you're a very seasoned investor and you understand why that particular theme or sub theme makes sense, I would stay away from those. But I would say that clearly international funds, NFOs that are forming completion of a product basket for newer players, provided that they have established so far with the existing offerings they have that they are a good bunch of people. Right? I'm caveating that. That should make sense. Otherwise, there is enough and more. I mean, one argument people make is that the fund industry has found amazing ways to skin the cat, right? We have n number of equity funds to kind of reach the same objective. So I would say that choose an NFO if it genuinely you can in 30 seconds say, I don't have anything like this in my portfolio. If you can't answer that in 30 seconds, it's probably worth waiting for some sense of track record to be built before you buy.
Anthony, are your fund managers bullish Indian equities for the next 3 to 5 years?
So it's interesting you asked that, Vivek. In fact, yesterday we had a conversation around the same topic because we had some interaction with clients and similar questions, right? And my head of equities had a very interesting take. He said, we've been in a bull market, if you think about it, since 2009, right? There was a time when the Nifty was 6,000 and everything, people thought it was crashing and burning. So I would say our perspective is, I think maybe moving beyond whether we are in a bull market or a bear market, or just to kind of take a view, where we sit today for a 3 and a 5 year time frame, do you believe that the markets will deliver you a positive outcome versus not? Is a simpler way to answer the question, rather than, because to our mind, that is far more certain than figuring out whether for us bull market or bear market is in some sense the environment, right? And that environment sometimes is dictated by liquidity, sometimes it is dictated by sentiment. What we actually believe at this juncture is that in the Indian context, corporate India has a lot of opportunities to deliver value in terms of earnings over the next 3 to 5 years. At the same time, if you take some of the elements we talked about earlier in this discussion, oil prices, high inflation, liquidity, etc., if you look at current market valuations in that context, I would believe that they are a tad expensive, which to me, therefore, would suggest that over the next 1 to year to 18 months, we will continue to see volatility. We shouldn't be surprised by a downside from here if it happens. But equally, as we've just seen in the last month and a half, where everybody predicted markets would continuously decline and they've been surprised, I think it's much easier to say, are we bullish about the fact that markets will be net positive, beating inflation returns 5 years from now? The answer to that is we are deeply convinced of that fact. And that to us should be the principal driver of the decision, rather than saying that we will just have a bull market for the next 5 years. I don't know that.
It's been a pleasure talking to you, Anthony. Thank you very much for making time to speak to viewers of Daily Hunt, and appreciate you coming by, and look forward to many more conversations with you. Thank you very much.
Thank you so much, Vivek. Pleasure talking as always.